Hello friends, welcome back to your channel. For such similar videos, kindly check the links given in the description box. Infosys launched a massive 9,300 crore share buyback on December 7th, and in today's video we will explain this and more. What can a company do when it has excess cash in its coffers? Well, for starters, it could reinvest this money, pick up a new project or an idea and work on it, or snatch up a smaller company in a different domain and improve its growth prospects. But if these options are limited, it could choose to reward its shareholders by sharing the proceeds with them. They could do this by paying out dividends, or they could do a share buyback wherein investors are afforded the opportunity to sell their shares back to the company at a premium. And while both avenues try to achieve the same objectives, there are subtle differences. With dividends, the company is forcing money down your throat whether you want it or not. But that's not the case during a buyback. The shareholder can choose whether they want to sell their shares back to the company or keep them. Also, there are two ways in which companies can execute buybacks. One is the open offer market route, and the other one is the tender route. The tender offer, in this case, the company makes an offer to buy back its shares at a particular price. It says, I will buy back a total of 10,000 shares at 100 rupees. This is 20% higher than what the stock is currently trading. You can part with your shares by filling out an application over the next 2 weeks, or the open market where everything happens on the stock exchange in this kind of buyback. The company says, listen, I want to buy back the shares from you, but the maximum I will pay is 100 rupees. You can sell the shares on the stock exchange and we will buy them from there. We won't get into a direct transactional relationship, and this will be valid for 6 months. Now, there's a difference between these two methods. In the tender offer, when the company said it will pay 100, that's exactly what it will pay. The price is fixed. If you are a shareholder who's selling the shares, you know what the price you get. However, in the open market offer, everything is routed through the stock exchange and price can vary. The 100 rupee figure indicates maximum sum the company is willing to pay. It could end up buying 5 shares at 85, it might buy another 5 shares at 90, and the final 10 at 97. So, unlike the tender route where the price is determined, the open market offer introduces several possibilities. They could end up shelling less money than they originally envisioned, and shareholders could walk away a bit disappointed with all this. This brings us to the question, how is Infosys doing its open offer? Well, it's going down the open market route. The offer opened on 7th December 2022 and was planning to buy back shares at a maximum price of 1850 per share. But the original announcement came way earlier. They announced the buyback on 13th of October when the company shares were trading at just 1414. That meant Infosys was ready to shell out a premium of nearly 30%. This is the gain that shareholders were expected to pocket. But because of the open market offer, shareholders may not make as much money as they originally intended. Okay, that explains the intervention. But why even conduct a buyback in the first place? Back in 2019, Infosys promised to conduct an annual exercise, that is, to return 85% of its free cash flow to its investors. It has excess cash and it's returning it. And this is the fourth buyback since 2017, so it was kind of expected. But of course, there are other factors. Dividends don't really push the stock price upwards. In fact, after a dividend is announced, the share price usually tanks by a similar amount. But buybacks help prop up the share price. When a company is willing to pay 30% extra or a premium on which the price at which the stock trades, then it's telling investors that the stock is undervalued. They are putting money where their mouth is, and it can fill investors with some degree of confidence. Needless to say, they might want to lap up the shares at this point. But there's another thing that buyback does to companies. It pads up the EPS or earnings per share. Let us explain how. When a company initiates a buyback, it reduces the number of shares in the market. For instance, if a company says that had 100 shares and makes a profit of 500, its EPS is 5. Now, if it decides to buy back 20 shares from its shareholders, it's basically retiring these shares from the market. The company now only has 80 shares available and suddenly the EPS changes from 5 to 6.25. It looks stunning, right? Basically, shareholders now get apportioned more earnings for every share they hold. It's not just that, the company looks cheaper from a valuation perspective. If a company's share price was 200, then the price to earnings multiple, which was earlier 40 times, also drops to 32. It looks like a bargain and could convince more investors to back the company. But Infosys may have to rethink this strategy in the next few years because it seems as though market regulator SEBI isn't particularly happy with the open market kind of buyback. They think that giving a company 6 months to buy back the shares is too much time. They want to cut it down to 66 working days by April 2023 and then slash it to 22 working days from April 2024. Their rationale is simple. This may result in artificial demand being created for the relevant company shares during an extended period of time and trading of shares occurring at an exaggerated price. Allowing for an extended buyback period thus prevents efficient price discovery. There is no denying that IT stocks, including Infosys, have been in a rut in the past year. While the benchmark Nifty 50 index has delivered a 6.5% return, the Nifty IT index, made up of only software companies, has fallen by 16%. When Infosys announced the buyback, its share price rallied. Shareholders now know that over the next 6 months, Infosys will buy shares at a price of 1850, and this creates artificial support for the stock price. So the next time a company announces a buyback, you know what to keep in mind. Until then, thanks for watching. Have a nice day.